Mortgage rates continue to decrease as the Federal Reserve raises the Fed funds rate once again. And are we in a recession? This is the weekly report on Major Money Matters. Welcome to Major Money Matters. My name is Major. I'm a mortgage broker powered by Edge Home Finance. And if this is your first time stumbling across this channel, I welcome you to like, comment, and subscribe, because every single week we post a weekly update to keep you informed about what's happening economically and how it may be affecting you as a home buyer or a home seller. Lots of information going on in the economic front this week, and I had to cut a lot of things out to keep this at a reasonable length. But let's start from this. Of course, the big news this week is Jerome Powell and the Federal Reserve hiking the Fed funds rate another 75 basis points. Now, I'm going to post this article here because if you follow this channel for a while, we have communicated, and we started communicating this back in January, how the Federal Reserve raising the Fed funds rates is actually good for mortgage rates. So lots of you have started to catch on to that, and you don't fall victim to other loan officers or realtors actually telling you, hey, you have to do something before the Federal Reserve locks in your interest, or before they raise the Fed funds rate. We want you to be informed, educated buyers. So, we've been talking about this for a while. People are starting to catch on, but there are some people still out there who are afraid of the Federal Reserve hiking the Fed funds rate. If you go back to my other video where I cover the real reason interest rates are rising, you can get some more background and more information about inflation and how it affects mortgage interest rates. But this week, the Federal Reserve raised the funds rate another 75 basis points to attempt to continue to combat inflation. Now, if you go back to my other weekly reports, we talk about the inflation reports and how those reports are trending. So I'm going to prove to you with this chart that the Federal Reserve raising the Fed funds rates is actually good for mortgages. So we take a look at this mortgage-backed security charts right here. And if you follow this channel, you know as this chart trends lower, interest rates are going up. And as this chart trends higher, interest rates are actually going down. So you see that the lowest point on this chart was back in the middle of June 13 specifically. And that's when mortgage rates essentially were at their highest point this year. As we bounce back from that point when the Fed raised the Fed funds rate back in June, you see mortgage rates start to come down. And then the Fed raised the Fed funds rates again on this past Wednesday. So you see that chart, the candlestick, that's the third from your right. That's the day that the Federal Reserve raised the Fed funds rate. Mortgage-backed securities reacted very well to that. And we got a good bounce back, and we saw interest rates actually begin to trend even lower or back to some sort of reasonable position where you're getting mortgages priced on conforming loans, mainly for your government loans, your FHA, VA, USDA, and your conventional loans. So we're seeing better and better pricing as inflation, or as investors believe that inflation is now under control. So another evidence here that the Fed raising the Fed funds rate is actually good for mortgage rates. The Fed raising the Fed funds rate by 0.75 does not mean that interest rates went up by 0.75. Why are the markets responding this way? Well, because we have GDP numbers, and those GDP numbers are gross domestic product of how much our economy actually produces, is actually at a negative 0.9. So our economy is producing less, not just producing less, it's less than zero. So you're seeing that the bond market believes, or they're interpreting these numbers as the economy doing worse. Therefore, you're seeing mortgage rates go down, or long-term bond rates go down also. Now, this is the second straight quarter of a decline. So the economy has produced less for 6 straight months. Now, typically, if you go back to Econ 101, they will tell you that 2 negative quarters of GDP means that the economy is in a recession. So I'll throw up this article here by John Bivens, and I don't know who John Bivens is. I don't know much about him. He actually writes a good article here, and he writes in the summary here, is the economy in a recession? And he says not yet. Now, Americans, this is something we've started to do recently. If we want to just lie about something, we just change the definition of it. We've had presidents who call stuff fake news, alternative facts. Goes back to a president, maybe or may not have had sexual relations with a woman, and he got up on TV and said, I did not have sexual relations with that woman. Now, we know that was a lie, but he was changing the definition for sexual relations and what that meant. But that started a trend of, if we don't like the name of something, we don't like what's going on, we just redefine it. So now we're not redefining a recession by 2 negative quarters of GDP. For some reason, maybe our economics are so entwined with our politics, we are going away from certain definitions. But in reality, it is my opinion that yes, we're in a recession because the recession is defined as 2 negative quarters of GDP. And you can read this article here by John Bivens. In it, he says 2 straight quarters criterion for a recession is a rule of thumb. Yes, it's a rule of thumb. It's what we're taught in school. It's what every economics class actually teaches. So even if we look at this chart here that looks at the Federal Reserve, and this is how the St. Louis Fed tracks mortgage rates. So if you take a look at this chart, essentially this chart shows you the trend of mortgage rates. I want you to look in the background there at the gray areas. The gray areas in this chart, and I've shown this chart to illustrate certain things before. Mainly it's illustrating that although interest rates, or at this time that I was showing this chart, was in the 5s, was in the high 5s when I first introduced this chart. Now interest rates are on average down in the low 5s. That's across every single program, non-QM and QM, investment properties, primary properties. So I use this chart to illustrate that interest rates are really not that bad compared to where they were in the 80s. But the gray section is what I really want you to look at, because the gray section illustrates a recession. A recession as defined as 2 negative quarters of gross domestic product, okay? So if we continue with that definition and we don't change that definition, we are in a recession, okay? Last thing I want to talk to you about, mortgage demand declines further even as interest rates drop a little bit. So I will tell you that there are not as many people out looking for mortgages. People are still scared off by interest rates. And I've tried to communicate to realtor partners, title partners, everyone, let's stop saying that interest rates are rising. Because if you go back to the MBS chart or my mortgage-backed security chart, that is simply untrue. Interest rates are actually falling. They are decreasing. So, but the message is not getting out to everyone that interest rates are decreasing. So if you're in the market right now for a home, I recommend that you be aggressive in getting into a home. I've said this before. When interest rates decrease, you can easily refinance that home, but you can't refinance a rent payment. So you get into a home when interest rates drop, then you do a streamlined refinance and drop your monthly payment. So if you can handle that monthly payment, now first of all, buy what you can afford, okay? Because there's no guarantee that you're going to be able to refinance. Refinancing is never a guarantee, but refinancing can be a great financial strategy to make sure that you're lowering your monthly payment. So get into a property now, and then you could refinance that home. But if you wait until mortgage rates get down into the 3s, I think you're going to have a situation where people start to flood the market once again, and you're having these battles where you're having people competing for homes once again. So while interest rates are at a reasonable level right now, which I believe they are, they're better than they were in June. We're trending to the downtrend. If you want to go back to my weekly report on last week, you're going to, I specifically go through some scenarios about where interest rates are for some specific loan types, but I recommend that you go back to there, but also understand that rates this week are a little bit better than they were when I did that video, and hopefully next week is a slow news week. Now next week we do get the jobs report. The jobs report comes out on Friday. I believe you're going to start to see unemployment tick up just a little bit, and if we see unemployment tick up just a little bit, the thing is that is another indication of a recession. So you could start to see some economists, while they're saying right now, well, we're not in a recession because we got this going on and that going on, and we're in a really good place in the economy. when you start adding all of these things up, you know, it's kind of hard to deny what is in front of you. If you want a quote, if you want to know whether you're getting a good deal on a mortgage, you want to know whether you're getting quoted a good deal, give me a call. I'll take a look at it. If it's a good deal, I'll tell you, hey, it's a good deal. I have people that text me all the time. Hey, this person's offering me this. Is it a good deal? And I look at it and I'm like, yeah, that's pretty much a good deal based on, you know, everything we're seeing. Because I'm a broker, I'm able to see multiple different banks. Sometimes people send me stuff and say, hey, can you do it? Can you take a look at the situation? Is it a good deal? And sometimes I'm like, that is absolutely atrocious. So if you want to look us up, give me a call, give my team a call. We'll definitely look at your situation and see whether you're getting a good deal. Talk to you soon. See you next time on Major Money.